What's up, guys? Welcome back to DCA. Tonight, what we're going to do is take a look at Bitcoin, the market cycle, and on-chain metrics. So if you're someone in the past who sort of ignored on-chain metrics, kind of brushed them aside, thought they're not important, or just never paid attention to them in general, I'm going to show you tonight why looking at on-chain metrics can actually give you one of the most pure looks at what's going on with the overall health of the market, okay? And specifically, we're going to look at Bitcoin. And the reason for this is Bitcoin is the market driver of any given market cycle in the cryptocurrency asset class, at least up until this point in time. All right. So if you guys like this type of content, don't forget to hit like and subscribe. Leave a comment and let me know what you think about what I'm showing you tonight and what you think we could be doing better or what we could do differently in the future. Also, if you're interested, we have a DCA index risk model, which shows you when a given asset is overheated or oversold and likely to start heading up from that point. This is a machine learning algorithm model, and you can sign up for this model on the Discord channel. So with that said, let's do it. Okay, guys, so this is the number of active addresses in orange and the price of Bitcoin in green. So unfortunately, right now we're sitting at just under $46,000. You can see that in orange, we have the active addresses. And what that means is it's basically, you can think of it as the number of addresses or the number of wallets, or however you want to think of it as, transacting on the Bitcoin network, okay? And the reason this matters is because the number of active addresses on the network typically corresponds directly to the price. We can see that if we go back in time here, actually, if we just move out to a weekly time frame. Here we're looking at the weekly time frame, and we're just going to bring the price down. And you can see that as the number of active addresses trends over time, the number of addresses has been moving up. And corresponding to that, we've been seeing the price move up. And you can think of it as something like, imagine a social network like Twitter or Facebook. The more people you have using your network, the more valuable it is. And that's no different for, Bitcoin or any other asset. The more people you have holding it, the more valuable it is. Bitcoin can't become a unit of exchange unless you have a large number of holders. So as this number, this orange line here, increases over time, what we see is that the price is also increasing. And while we aren't currently sitting at an all-time high for the number of active addresses, what we are seeing is that this value is trending up over time. Okay, so if we go all the way back down here, you can see that we're essentially just trending up over time. And that sort of gives us the overall macro level picture. And by the way, that's what we want to continue to see. We need to see this number of active addresses continue to rise over time, because as it does, we see the price rise commensurately. So that's sort of our macro level picture. But what about what's going on right now? Okay, so we know that overall the price of Bitcoin has been falling basically since November. Okay, we hit that peak at around $69,000, and then we've been falling since mid to late November. And what you can see is that the number of active addresses sort of plummeted after May, and that makes sense. We had that massive price drop in May, and a lot of people left, a lot of speculators left left Bitcoin, left cryptocurrency in general. So we're left with, a more, as a percentage of the whole, we're left with more long-term holders. Okay. But what you can see is once we hit this bottom here, right around here in July, and that sort of corresponds with our lowest point for number of active addresses. And since then, we've just been trending up. Now, we do have these pullbacks. We started to see a significant pullback in December. We've seen a little pullback now, but you'll note that they're basically all just coming right back down to this trend line. And overall, we're continuing to head up. So let's go ahead and take a look at the next metric then. Basically, we're looking at the Bitcoin long-term and short-term holders. And there's a key thing I want you to note here. Notice the long-term holders is in blue. All right. The short-term holders are in orange, and then the price is in black. what we see is that when we move and start hitting these market cycle peaks, there's a consistent theme that occurs. Long-term holders are known as smart money. And the reason for that is long-term holders are so much more profitable, especially in cryptocurrency, than are short-term holders that, it's not even really worth, I could try and sit here and prove it to you, but all you have to do is sit back and think about it. Long-term holders are consistently making multi-thousand% gains across different assets in the cryptocurrency asset class. Short-term holders are trying to grind out maybe 100% at best over, very small trades. And a lot of times your short-term holders are the same people that are panic selling. Okay. So I'm not trying to insult anyone here. I'm simply stating a fact. The gains that you can make in cryptocurrency, if you're able to select valuable assets that are creating value, that have use cases, that have partnerships, that have total value locked, if you're able to invest in those assets and just simply hold them until they, go on these massive parabolic runs, which they do over and over and over again. If you're able to do that, you're typically going to be much more successful in this market than you're going to be trying to watch day traders on YouTube pretend like they're making money in crypto. Okay. Look at what happens to the long-term holders once we get into bull market phases. Long-term holders, notice this line starts to go down. Then we reach our first peak in 2013. Then right before our second peak, this starts to go down. Then what happens? We go into a bear market when no one cares about crypto anymore, except the long-term holders. They are acquiring during the bear market. And then what happens? Right when we reach our prior all-time high, you have these people buying in during the bull run. They're buying in, FOMOing in, and your long-term holders are selling to them, and your short-term holders, or the dumb money, is buying from your long-term holders. All right. We see it here. We see it here in the second peak of the 2013 market cycle. We see it in 2017. And then you see it yet again, like clockwork, right here in 2020 and 2021. The second that we reach this prior all-time high, the smart money says, okay, people are going to be FOMOing in now. Let's sell to them. They will be our exit liquidity. So you have to ask yourself, do you want to be someone's exit liquidity, or do you want to sell to these guys that are FOMOing in right as the price is going up? All right. So this is just a general trend, and I'm showing it to sort of just try and show you how smart money is thinking about the market and how dumb money, or, it doesn't mean you are dumb if you're doing this, because at the end of the day, in the cryptocurrency asset class, almost everyone, very few people aren't this guy, at least for some amount of time, because it's a learning curve. And the cost of the learning curve is being this guy for at least a while. And then you can become this guy once you realize how the market is actually working. Once you've been burned enough times, then you get to stop being orange guy and become blue guy. Okay, guys. So this is basically a graphical representation in orange of the number of short-term holders. And I should have mentioned this before, but a short-term holder is defined as someone who holds Bitcoin for less than 150 days, or holds any asset for less than 150 days. Because after 150 days of holding an asset, it becomes statistically much less likely that you're going to sell the asset. So you enter sort of that non-arbitrary long-term holder category then after 150 days. So we're looking back in 2018, and you see right when we hit this market cycle peak, short-term holders plummet. Okay. This can also be thought of as a loss of retail investor interest in the market. And when retail investors lose interest in the market, they pretty much, they start to capitulate their assets. And we saw that happen in May as well. You basically had a massive loss of interest from the retail market. All right. And even, coming through, basically our current time where we're at right now, there's been no significant recovery in the interest from the retail market. We're still just hanging down here at these very low levels. And what have we said happens when the, as you can call them, dumb money or retail investors, as they lose interest, who gains interest in the asset? So this is a chart of your long-term holders now in orange. And you can see that right in May, after they dumped their assets, prior to, starting in 2020, right when we reached that prior all-time high of $20,000, they started dumping their assets into the retail market. Then when we had this capitulation event in May after the Elon Musk tweet, that's when your retail market panics. And what happens with the smart money? Well, they see your panic as an opportunity to start buying. So they start accruing the asset. Now we have something interesting happen in here right around the beginning of November. So beginning of November into basically into December, we've had this pretty slow downward movement of the number or the total supply held by long-term holders. And you may be asking, well, why is that? Well, in my opinion, there's two primary reasons that we need to look at. So number one, we reached a prior all-time high, albeit it was barely above our previous all-time high. And when you account for things like money supply, etc., maybe we didn't even reach an all-time high or barely reached all-time high, maybe right at the level where we were at back in April. But perhaps the bigger reason, China has been cracking down on its population and essentially forcing them to sell their assets. In addition to this, the exchanges have been giving the Chinese market deadlines to exit the market, or they will no longer have access to their assets. So I think, in combination with the fact that we reached this prior all-time high, and you're seeing this sort of transition period where a lot of Chinese investors are being forced to exit the market, I think that's why you're seeing Bitcoin at the moment sort of experiencing this, somewhat downtrending long-term holder supply. So you sort of have these two issues occurring at the same time and causing this slow downward price movement that we're seeing. In fact, if you look at a chart demonstrating when the selling is occurring, a vast majority of the sell pressure is coming during Asian market times. I think there's a lot of evidence to suggest that at the moment, the Chinese market, be they long-term holders, short-term holders, it doesn't matter. We've seen this period of time where they have been sort of, getting rid of their assets. And I think that's why we've seen this general downward trend, which kind of started in mid-November, early November, and went through December. And now it will be interesting to see if this sort of plateaus off. I think right at the beginning of the year, a lot of people aren't going to realize this, and you're going to have a large number of smaller investors are going to sort of lose their nerve as the price goes lower and lower. And that could continue for a while. In fact, the price could go significantly lower, but I think the market can still stabilize and recover from these events. So I think there's the sort of this confluence of macro level economic events all happening at the same time, some of them directly related to the cryptocurrency asset class and others entirely unrelated, such as COVID, such as the specter of rising interest rates, etc. So I do believe that there is going to be sort of an interest in bigger institutional type investors getting into the market. And, they're not going to want to telegraph this happening because they don't want retail FOMOing in at the same time that they're trying to get in. In fact, they want the price to be as low as possible. They want the retail investor to forget about Bitcoin, forget about crypto, pretend it never happened, so they can get in at a, what they determine to be a fair market value for the asset. And then they want you to know about it. So I think you're going to hear sort of a situation where, you're getting this FUD in the media, and you're seeing all these events are going to be happening that are sort of going to pile up against the asset while the institutions are getting into the asset, and then they'll let you know about it later so you can FOMO back in, right? So that's kind of I don't like to do a lot of speculation of that nature, because that's sort of bordering on the tinfoil hat theories that you hear out here on YouTube all the time. But I do suspect that if the institutions are going to get into Bitcoin, they're not going to want everyone to know about it. They don't want you driving the price up while they're trying to buy it, is the bottom line. So that's going to be it for this one, guys. Remember, if you guys like this type of content, hit like and subscribe. Head over to the Discord channel where you can sign up for the DCA Index Risk Model. It's a free machine learning algorithm model which identifies market cycle peaks and bottoms. And we've done numerous videos detailing what goes into the model, how it works, etc. And until next time, as usual, see you.